Hi, I'm John Celestri, and we're here at RECon 2019 in Las Vegas, and we're here with Chris Sands of Sands Investment Group. Chris, good to see you.
Good to see you too, John. Thanks for having me today.
Thanks for the time.
Yeah.
So what are you seeing in terms of retailers adjusting to e-commerce, the brick and mortar guys?
Yeah, well, the obvious trends that we're seeing in terms of adjustments, they're shortening their footprint of the actual spaces that they're occupying.
Right.
So you'll see a box that'll go from 65,000 square feet to 40,000 square feet, or we're seeing concepts like a Best Buy, for example, will be downsizing their footprint from 45,000 square feet to 30,000 square feet. So the logical adjustments are just the footprint size. We're seeing that the base terms that they're signing are sometimes shorter, so they can predict their future a little bit more clearly and then adjust accordingly to market trends. And I just think in terms of option periods, they're definitely being more nimble.
Really?
If landlords are wanting an extension on a lease as a negotiation tactic, they're asking for TIs or improvements on the store in order to upfit or maybe rebrand it or make it a little bit more up to the standards of what a new concept or a new prototype would look like. And so they're using that as tactics in an effort to make sure that they could be adjusting to what might come with e-commerce and how that might impact the retailers moving forward.
What are they doing with the shortened footprint? Does that mean inventory is going off property?
No, I should say some of it is. It depends on the concept and the brands. So I think that in terms of, like, take an Academy Sports, for example. They used to have large warehouses as a back portion to their site.
Right.
So maybe a 60 to 80 or 100,000 square foot footprint might be something that we'd be more comfortable in. In past times. They're now adjusting to 60 or less. So the inventory that they have within a store is definitely something that they've been able to use more of an online presence. And then as opportunities arise, they can, it's easier for them to have a smaller footprint and to operate out of in an effort to make sure that they don't have too big of a footprint, and ultimately then they're paying more rent than they need to, and it impacts their overall sales.
Who are you seeing? What formats, what brands are most comfortable going forward with the e-commerce, blend of bricks and clicks?
Yeah, so the daily need concepts are what is really thriving today. So if you look at the concepts like grocery stores, auto repair, collision concepts, medical office, naturally QSR and restaurants, quick service restaurants. So anything that has sort of that daily needs concept, or even the experiential concepts like these trampoline parks or skydiving. So it's something that is still this need for people to get out and experience it from a humanization or human interaction. That is what we're seeing are still thriving in today's market.
More the internet proof type.
Exactly.
Interesting.
Yeah.
So what does all of this mean for investors?
Well, I think on the acquisition and investor side, the buyers that are buying are definitely gravitating towards concepts that have two things. One, the smaller footprint, so that they have the safeguard of knowing that if they were to lose a tenant, they have the capability of re-tenanting the properties. But again, they're gravitating towards those daily needs concepts. So, definitely while you're seeing the lower cap rate deals going for grocery stores or for some of these even car washes or some of these concepts that that the recession-proof concepts are going to thrive in a market that may come. From the seller side, I think you're seeing owners divesting of properties that have these larger footprints. And so naturally you'll see some of our family office clients are divesting of Kohl's or some of these other big box concepts just as a way to mitigate the future of what might be a re-tenanting issue down the road.
Excellent, Chris. Thank you so much for your time.
Thank you so much.
Really appreciate it. You can find out more if you go to signn.com. And for all of your commercial real estate news, of course, GlobeSt.com. Thank you very much, and thank you, Chris.
Thank you, John. Good seeing you.
You too.